Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It's Tuesday, December 18th, 2018. Hope you had a good weekend. I'm coming at you a day later than usual. I had some stuff I had to get done yesterday. But you're going to take a ride with me right now as I am driving into Manhattan from my house on Long Island to go. I have a lunch that I have to go to, which we'll talk about in a little bit. But so you're gonna enjoy the what should be a 30-minute drive, which normally takes an hour and a half to 2 hours, sometimes 2.5 hours, depending on traffic, and that is after leaving after rush hour. But you just can't make up the traffic. You just can't make up the traffic around here. Anyway, so last night, big night. I stayed up. It was good football night, Saints and Panthers. I'm just not a Panthers fan. I'm not a Cam Newton fan. I'm not a fan of his play. A huge fan of Drew Brees. But so it was good. Saints squeaked out a win. I'm not on the Saints bandwagon, but I always enjoy watching them play. And then I stayed up late. I had the Islanders, and I know, I got plenty of emails when I said the Islanders were first place earlier, but they're hanging in tough. They're a young team. Tavares is gone. Thank God. See you, John. But they're playing really well. Took my kid to the game Saturday night back at the old barn, the Nassau Coliseum, where they abandoned to go play in the Barclays Center, which was a disaster. You've heard me talk about that. But they're playing about half their home games back at this 40-year-old monstrosity called the Nassau Coliseum. But hey, it's home. It's cozy. So I took my kid. We went and saw them play the Red Wings. They won 3-2. So it was a good game. 4-3 in overtime, actually, I should say. But last night they were out playing in Colorado, so they just starting to play well. They went through a little tough skid, and so it was a late night, a little later night game for East Coast time. It's great. I love that. So football's winding, is starting, and then I've got hockey starting an hour later. So I'm reading, and it's a good night. I've helped my kids with some stuff, and it's Christmas time, right? So you're around the house. My wife's online shopping and wrapping a few things, and the kids are just bopping around. But it was good. So I have the Islanders play, and it's a great game. Going into Colorado, always a tough place to play. The altitude is so much higher. It's tough for visiting teams, and the Avalanche have a really good team this year. So I was like, shit, they're starting a 4-game road trip. They're going to lose in Colorado. They played spectacularly, and they won 4-1. So like, God, I was like a kid. Canister. It was 3-1 though, with a few minutes to go, and I was pacing in my little man cave because I was thinking, oh God, they're just so typical. They're going to give it up, and I was all stressed out. I couldn't look for a few seconds when the Avs had the puck in the Islanders zone and they're flying around. They won, and then I sit down and I'm just doing a little reading, and I fall asleep on my couch in my man cave. And instead of going right up to bed like I should, I don't. And because I wanted to get a little extra reading done. Well, sure enough, the little extra reading, I fall asleep and I wake up and it's 5 a.m. Like, really? Right? So now I'm pissed off at myself because I didn't get a great night's sleep. You fall asleep on the couch. It's like, oh, come on. And, the body ain't what it used to be. I got the, aches and pains in my neck and my shoulder, and I feel my knee. And then I thought my wife had said she had closed up for the night. That's kind of our term. Did you shut the lights? Did you make sure the dog went out? Did you put the alarm on? And you're kind of good to go. Somewhere along the way, I thought she told me that, and she didn't. So as I'm going through the house to work my way up to to my bedroom, every light in the house is on, every single light. And I'm having flashbacks to when I was growing up, and I can hear my grandparents raised me, just saying, "What am I, Ben Franklin? Well, did I invent electricity? Does money grow on trees?" And so I hear myself. Every single light in the house is on. Everything. There's music playing. So clearly there's a miscommunication. My wife thought I was going to shut everything off, but that wasn't the point, because now I'm roaming around the house, 5:15, and I'm hearing myself ranting out loud saying, "Are you kidding me? Like, what is this? Like, look at this." If you looked from the street looking in, you'd be like, "Oh God, these guys they got a party going on." But that's like normal. And I'm sitting there, and so I'm ranting and raving to myself. So I'm not in a good mood for that. I go to bed, and I get up, and I wake up to my son playing his rap music. Now, I don't know if I shared this with you in the past, my rap music story, but back in August I was in Singapore, and in Hong Kong, and I was in a hotel in Singapore, and I was there. It was a trip, and I was meeting that day with some investors, and so I got an early start, and I'm in the hotel in the gym in the morning, and I don't know, it's about 5 a.m. and there's not a soul in the gym, and it's perfect. I forgot my earbuds in the room, so rather than run upstairs, I said, okay, nobody's in here, so I don't want to be rude ever and play my music, but I'll play it loud off my phone because of no one's in here, so that's fine. So I'm working out. I'm getting into a good workout. I'm working out pretty hard, and I kind of lose sight of where I am, and I'm not really hearing the music. And a couple of people start to come into the gym, and somebody says to me, "Excuse me, like that music's offensive." And I was like, "Oh, gee." At first I think it's the sound, but it turns out what it was somehow, and I give up trying to figure out Apple iTunes and whose lists are whose. My kids are always changing passwords to something. I just, whatever's there I play. I think I have a playlist that I think I know called Dad's Playlist, but it gets populated with whatever. Well, sure enough, my son's music is on there. Now, he's 12. He's going to be 13 in a few months. And, we monitor, or my wife really does, monitors any social media. She's all over him like a hawk. And he's a good kid, but he's 12 and he's a knucklehead, right? 12-year-old boy. And, he's normal. He's a bright kid, but God, he could do some stupid things. And so you got to be all over him. And, and I try to, but I'm oblivious to some things. So my wife kind of is all over that. But anyway, the music thing is, they always figure a workaround, my kids. So, no expletives with the music. But you go to the Apple iTunes store and you look at the top 20 songs, everything is. It's rap with really bad language, and the words don't make sense. And so we tell them you can't buy the expletive songs, and somehow they work their way into the playlist. And well, that happened to be playing in the hotel that day. And so I go back to the room and I listen to some of these songs, and I started to get really pissed off. I'm like, you got to be kidding me. A, I have no idea what they're saying. B, the language is so vulgar, it's crazy. And C, he's not listening to these. So I think there were 340 some odd songs. I just deleted the whole damn thing. I'm not even giving him a choice. It was gone. Called up later that day or whenever I called, and told him, read him a little bit of the riot act, and that was that. Well, so here he is back. He's back to the somewhere along the way. I guess he's back, and he's got a few rap songs. I hear it this morning, and so he then hits me with, "Dad, I want to go to. Can you take me to a concert in March?" And what they typically do, the way we kind of around the house is, my wife is the day-to-day rule maker, and she's in charge of the house. I mean, that's kind of how it works. And as she'll tell me, I have a heart the size of Texas, but sometimes I'm a little clueless on the judgment part on what's for the kids what's right or wrong. And, so she makes the rules. We all follow them. It works beautifully for our family. So it might not work for everyone, but that's good. Well, in this particular instance, what tends to happen is the kids will go to mom, and mom will say no, and then they come to me, of course, like kids do. And for a while, I would say, oh yeah, sure, that sounds reasonable, because she's more of a stickler on the day to day, and I'm more flexible until I'm not. But they're smart, right? So they know that, and they come to me. But I've learned, after my wife's reminded me 1,000 times, I finally learned that check with mom. What did mom say? Because I'm going to get overruled anyway. So we go with that. And so when he came to me this morning, he said, Dad, can you take me to a concert? He caught me off guard. And I said, yeah, no, sure, yeah, I'm happy to go. I'm thinking, yeah, I'll chaperone. I didn't ask to think who it was, and it's some rapper that he wants to go see. And so my wife, of course, reminds me, like, are you out of your mind? Like, no. And then, of course, they print off the music, print off the words, and it's just not happening. So I have to, of course, say no. And then, of course, geez, Dad, why can't you make your own decision? So that's been my morning so far. But then I felt compelled to, I reverted back. I was my grandpa. I was ranting then about the lights on. And what am I, Ben Franklin? So, I was hearing my grandfather in myself. It was kind of funny. Anyway, that's been my day. So, turn to the markets a little bit. So far, by the way, traffic's not too terrible. I hate to jinx myself, but I'm a little surprised that we'll go with it. It's been tough, right? The market's been getting hammered, right? Ticket. I'm not going to rehash. I talk about this stuff fairly regularly. China trade war tensions, economy slowing down, people concerned about that, Fed rate hikes, right? Is the Fed going to hike too much, overshoot, and what's that going to do? And then when it looked as though, Powell, when he spoke in New York a few weeks ago, it looked like he was going to back off, and the market got a little relief. But it's just, maybe that's too little, too late, right? And you've been hearing me just ring the caution bell for quite some time now. And again, not bombastically, but hey, know what you own and make sure you're not being piggish with any gains that you might have had. So now, like, okay, right? I chuckle because now people are saying, hey, what should I do? Oh, okay. I don't know. Let's see. The S&P's now 8 this month. It's been hammered. It was hammered last month. What should you do now? You got to start planning. You got to start thinking forward, thinking ahead, right? Think 2 steps ahead. So right now, I don't know. I was reading a really good piece this morning. Bloomberg interviewed Stan Druckenmiller, without doubt the greatest hedge fund manager ever. 30% a year with no down years until he retired in 2010. Really, to get better than that. Pragmatic, brilliant, just a stunning portfolio manager. Now he runs his own family office, and he basically was saying he sees a tough outlook for next 3 to 5 years, and really, he said, hey, really, you shouldn't be raising rates right now, right? We are kind of where we are, and I'm driving. I don't have my notes or an article in front of me, but essentially, you don't want to put the brakes on too fast here and send the markets into more of a tailspin. So he was talking, and he made a really good point in saying, during these times, like now, is not when he's out there shorting stocks typically, right? Because you can get these violent snapback rallies. He talks about it, and you can, right? But everyone's inclination, and because I see it on the inbounds that I get, because people know me as a guy who likes to short stocks, and has been doing it for a long time. It's, now what should I be doing? Well, the market's already had a huge move, right? And the way Druckenmiller positioned it was, hey, now I'm thinking the Fed's going to have to come down. Rates could, you could see the 2-year note go from 270 down to 50 basis points in the not too distant future. And if that's the case, then you want to own treasuries because rates go down, bond prices go up, right? That's a different tune than you would have heard not too long ago. Everyone anticipating rates just keep going up and up and up. But we're seeing the challenges that the Fed is having from trying to get out of what global central bank easing has done for all these years. And so it's tough sledding out there. He mentioned that he's been short the financials. Banks do well when interest rates go up, and they don't do well when the rates are down. Right? So, just start to think about that when you're thinking about how to position your portfolio for what's going on. Don't just run out bombastically and say, "Oh my God, I got to go short, so I got to do this." You should not. I hate to say what you should have been doing, but hopefully you have started to exhibit a little bit of caution in the portfolio, and you just continue to be cautious. Oftentimes cash is a wonderful hedge. So just something to think about. We're gonna talk a little bit of uranium today. I have coming on the podcast as my guest Arthur Hyde, and Arthur is a good friend of mine, along with his partner Adam Rodman. They run a hedge fund focused solely on uranium investing, which listeners know, as do I. So their fund is called Segra Resource Partners, and yes, there's 4 or 5 of us in the world who do that, dedicated funds, and this is one of them. And Art and I are going to talk about the world of nuclear power and uranium. And so let's get it going. Arthur Hyde, welcome to the podcast.
Thanks for having me on, Mike. Nice to speak with you.
You bet, buddy. So for listeners who don't know, Arthur, and I'm going to call him Art, Art runs, along with his partner Adam Rodman, a uranium-focused hedge fund called Segra Resource Partners. And Art, Adam, and I are buddies and competitors and buddies. Hey, that could happen, right? In the small world of uranium, you get to know. But I met Art. I met Adam through a good friend of mine down in Dallas, which is where the fund is based, and we've gotten to know each other over the years, and I have a great deal of respect for Adam and Art. And I love chatting with them, and they have really, really smart views, I think, and really worth listening to. So, Art, for those who don't know, tell us your background.
Sure, definitely. So Segra Capital Management is a Dallas-based global diversified hedge fund manager, and we launched, as Mike said, Segra Resource Partners, which is our uranium and nuclear power specific vehicle, in the second quarter of this year. We had been focused on the trade for several years previously in our main fund, and we maybe came at this a little bit differently from some other folks in the industry. If you've been following uranium for a while, you'll see that there's a handful of guys that have just kind of been around since the last cycle. They really are resource investors, often Canadian or Australian in base, and they come at it from the supply side. They know the mining companies. We were, our background is really more in emerging markets and underfollowed markets, and a big part of our process at Segra has always been to look at Chinese capital flows and Chinese outbound investment, and to try to look at which markets, which industries those capital flows were moving towards. So, back in, I guess it was 2015, there were several IPOs in China, and a few of them were nuclear power focused, where these companies were literally raising billions of dollars with the express intent of building nuclear reactors and then acquiring uranium. And we had a background of actually trading the cycle at previous roles in the upcycle in 2008 and 9, and then post Fukushima on the short side, actually. And so when those IPOs occurred, it piqued our interest. We started to look at market dynamics and kind of wrap our arms around some of the big picture macro trends in the industry. And since then, we've kind of spent the last 3 years getting to know both the ins and outs of the macro, but also the micro. You know, we think company-specific analysis is super important here, as I know you do, Mike. But I think what's maybe a little bit different about our background within this sector is that we really do come at it from the EM side and from the demand side, which maybe makes our point of view a bit different from your average uranium-focused investor.
Well, you know, Art, you just said something that's fascinating because as you do, I do, we talk to investors, potential investors who inquire from around the world. And we mostly are institutional investors, some high net worth individuals. And what you tend to find is, at least, it'd be interested to hear your view. To me, when I'm talking about the uranium opportunity and the uranium cycle and nuclear power cycle, when I'm speaking with Asian investors, you don't have to sell them on the growth of nuclear power. But when you're speaking with Western investors, it's a completely different initial conversation because there's skepticism about it. So you mentioned the EM aspect to it, and you were familiar with nuclear power because that's where it's growing. And, you know, and I was mentioning earlier in the podcast before you came on, I was in Singapore and Hong Kong back in August, and it's just such a different set of conversations because, you know, I think as you've concluded, I've concluded, nuclear power is a growth business. And I think that's something that gets lost on people.
I think that's really well put, and we'd agree with your sentiment completely. You know, a lot of, you know, typically when we walk investors through the way we see supply and demand shaping up, you know, a lot of our conversations are spent with, okay, well, why does this opportunity exist? If you're so right and the story is this interesting and misunderstood, you know, how can that be? The capital markets tend to be efficient. And I think you're right. Traditionally, the demand centers of nuclear power and of uranium were, you know, in the United States and Western Europe and Japan. And if you're an investor in those markets over the last, you know, 8 to 10 years, you haven't seen a lot of positive headlines. I mean, I think that investors in the U.S., investors in Canada are massively skewed by, you know, headlines around Vogtle and Summer in the U.S. And this feeling that nuclear power is both, you know, too expensive and too complicated to build. You get a diametrically opposed view talking with Asian investors. They tend to get the macro very quickly, and it's a question of, you know, how do you play? You know, what companies do you look at? It's a very different conversation. It's a smart point, and I think that bias is again what kind of creates this opportunity.
Well, you know, and you said something too, is you looked at it from the demand side. And I've said this on the podcast a billion times, when I started, like you guys, I'm a generalist just like you guys are, right? Which I think, and we could talk about that, is how it really helps when you're looking at elongated cycles and things that are in really long bear markets or bull markets, because the experts, quote unquote, tend to buy into the existing narrative. And when you come at it with a financial framework that's unbiased and say, hey, let me look at this with a fresh set of eyes, you're not engulfed in that in the prevailing sentiment. When I came at it, it was, hey, I'm a Westerner. I don't know about nuclear power. I see the asset class that's been destroyed. I see the commodity that's been annihilated. Yeah, that's interesting. But is there demand? And that's how I came at it. Let's build out like you guys did. I know you did as well. Build out every reactor in the world. Let's look at it. And you conclude it's a growth business. And it's such a big story because I'm curious to hear your view. When I did that, Art, it was once I got the demand side down and then you understand the economics of supply, it actually got pretty easy because then you start to say, well, there's no choice. You can't sell it for 25 or 20 or 18 and pull it out for 40 or 50. That doesn't work, right? That makes those decisions from a corporate standpoint much easier. I mean, how did you guys start to, once you got the demand side, how did you start to think about it?
Well, I'll say a few things. I mean, yeah, I think there's a very simple narrative to nuclear that's kind of been around for a while, and I think Rick Rule likes to say a line, something along the lines of, if uranium prices don't go up, the lights go out. I think there is some simplicity there that may be accurate. He's obviously a very intelligent investor. What I'd say is that when you get past the basic supply and demand dynamics that people have kind of talked about, there's a much more nuanced set of research that I think you need to do to really understand what's driving things. So when we approached it, and again, we started looking at it in 2015, we found specific companies that we found very interesting. But we had some skepticism on the macro. We did kind of look at the space and say we hadn't seen supply discipline. You hadn't seen a new generation of reactors delivered into China yet. These Gen 3 reactors were still being built. So there wasn't certainty in terms of delivery dates. What I'd highlight is that in the last 18 months, the number of positive headlines, the number of positive fundamental shifts that have taken place in this sector is absolutely astounding. Many of the question marks we had in our macro thesis have been answered. Supply discipline has been swift and is impacting the market today. And I think what you're left with is a group of investors that maybe have followed this sitting around saying, well, if we're so right, why haven't prices moved? And that's where I think kind of the game theory of the fuel buyer and producers really comes into play. And I know you've talked about it in the past.
Well, so let's talk about that. One of the things that I don't know if you heard one of, I wouldn't expect you to because you're busy, but I had mentioned that I had spoken at the NEI conference in Boston to a bunch of fuel buyers, and afterwards Andrea Janetta from Fuel Cycle Week approached me and said, well, what are you doing here? Why are you talking about costs? And you put down the fuel buyers, and I was like, wow, we're two ships sailing past each other in the night, not seeing each other. I don't. I said, let me explain to you. I just talk economics of mining, and the costs are too high, and the price is too low, and it's going to flip on its head. I said, but I think fuel buyers are incredibly bright people. And when I spoke at the conference, I said to them, kudos to you for holding out of the market. You've done a wonderful job. And the miners, and I said, the quote, should be ashamed of themselves that they increased production during a downturn. And for so many reasons, the last several years have been horrific stewards of shareholder capital. Not all of them, but most of them, in diluting shareholders till kingdom come by not making wise decisions on exploration or development or production. And she said, wow. And I said, no, the fuel buyer is exceptionally bright. But there just comes a point in time where no matter how bright they are, the economics of those people who supply them don't work, and things have to change. Talk about your view on fuel buyers and how you view them.
It's a good topic, and I think people don't necessarily focus on it enough. I think you're 100% right. There's a tendency, especially if you see people tweeting about uranium, to say that utilities are stupid. I think quite the opposite. I think they're extremely intelligent and tend to be pretty well informed. What I'd say is that there's just no market incentive structure that tells them to make a decision today. And what I mean by that, let's just think about what's happened. Let's take us back to last summer. Uranium's trading, at $18, $20, $21. If you're sitting in a fuel buyer seat, that out into the middle of the next decade, you're undercovered. You have a sense for what your deliveries look like. And you also see the Bloomberg screen showing, let's say, $21 in spot. And when you call Camco or you call a U.S. producer and you say, I'd like a quote for deliveries into the middle of the next decade, you would likely get a response with a 5 or 6 handle. So maybe Camco comes back and says, we're going to start at 50 and escalate it. A U.S. producer might be at 60 and be escalating. And there's no fuel buyer in the world that's incentivized to go to their boss and say, I know that the screen's showing 21, but these guys are telling me the real offer is at 60. And they're telling me that the $31 or $32 I see quoted as turn pricing is a fallacy and that there's not really pounds there. And I think that's what was happening. I think there was no incentive for somebody to cross 100% bid offer in a commodity to be the first one to lock up pounds. And so, we talked to a lot of utilities, a lot of market participants, and 18 months ago, I'd say they were not hyper focused on uranium per se because they hadn't seen supply discipline hit, but they weren't of the view that they weren't buying because they thought prices should be lower. There wasn't a lot of people in those seats saying, well, I'm not buying at 21 because I think I'm going to buy at 12. They didn't necessarily have a strong view on price, and honestly, a lot of them knew that given the cost structure of the industry, they probably had to buy somewhere higher. They just didn't think 50 seemed fair, or it didn't seem actionable. And so kind of if you fast forward to today, sorry to be long-winded on this one, and you think about
I own long-winded, so you could be as long-winded as you want.
you'd fit right in on
I'm always long-winded, and you're not being
Segre team does too. So if you think about what Camco's done, you've got to think of their clients. Their clients are undersupplied into the middle of the next decade. They know they can't pay that massive bid offer spread. Nobody wants to be the first one in the pool. Nobody's incentivized to do so. Nobody's getting a bonus based on being the first one to buy at 50 rather than 70. So Camco sits there and says, okay, we're going to close that bid offer spread actively. We're going to take pounds off the market. We're going to close MacArthur, and we're actually going to buy spot in order to compress that $21 price up towards our 50 offer. Yep. And this is what people don't understand. There was a line, I think Tim said it in their last earnings call. He said, if we're buying pounds at 50 or 60, we'll do so. And that'll just prove that we're in a much better market environment and that the market's seeing what we see, something like that. Yeah. You had all these analysts and all these market commentators saying, well, they can produce at X. Why would they ever buy a pound at $50? How does that make sense? And the answer is it doesn't matter what the price of the incremental pound is. Let's say Camco is able to push spot from $29 today up to $40. I don't know exactly what time period, but let's say they're able to do it. Now you have that same call with a fuel buyer. And what's changed is last time we talked, the bid was at 21 and the offer was at 50. Well, now the market's doubled, spot's at 40. And now Camco is only charging me a 25% premium to the market, but things are really moving. And that's when all the fuel buyers pull back the chart and see how extreme these moves can be, and somebody crosses the line. So I think that incentive structure and understanding exactly what Camco is doing is extremely important to understand what is going to shift this market and understand how quickly it can happen.
Art, it's so important. You and I, we talk about it all the time. I talk about it on the podcast, the power of incentives, and it's so important, especially here. But let's take a little step back and talk about. Hang on, hey Art. Right now, I'm driving into the city, and Garrett, you could keep this on the podcast. That's okay. And Art and I are actually having lunch together today. He's north of the city, I'm east of the city, and we're converging into the city. I'm driving, he's going to be taking a train, and we're actually having lunch with the CEO of Energy Fuels, Mark Chalmers. We're going to visit with him today. But I just had to get my Easy Pass out, so I didn't get one of those tickets in the mail because I forgot because I'm talking on the phone. But let's roll back, let's step back, because you said something that's interesting is, well, hey, wait a second. It's the markets typically are pretty efficient in most things. Thank God they're not, because you and I wouldn't have jobs ever. But how does a fuel buyer, how does uranium get to 21 if the price to pull it out of the ground is much, 40, 50, pick a number? And we'll talk about how the mining companies are most of them full of shit with the prices that they say their costs are. But how is it possible that there's such a disconnect in the market? To me, it's the most inefficient, opaque market I've ever seen. And married that with the incentives to not peel the onion back as a fuel buyer, talk to me about how does that disconnect happen?
Yeah, I mean, happy to. I think that the "how did we get here" question is definitely important.
Yep.
And I think that people don't fully appreciate how many different converging factors drove the bear market. So people look back and they say, okay, Fukushima hit, and it took Japan's 40 some odd reactors offline, removed 10% of global demand, and that is really the driving factor. But what they fail to really understand is that there was also a big supply shift. I mean, Kazakhstan ramped up from 4% of the world's supply in the early 2000s to 40. You had some of the best assets in the world, Camcos in Canada, come on full steam, all right into this drop in demand. And so it was those converging factors that made the bear market as long as it's been. But the other key component is contracting. And, if you step back, I mean, in its most simple terms, if this is your first time hearing about uranium and you're trying to learn about contracting, just think about it as whether your pantry's full or not. These utilities, because reactors are 60 some odd year assets, they tend to hold a certain amount of inventory, but they also tend to forward contract a significant portion of their uranium demand. And that's actually positive for the market. It was symbiotic. There was a connection between utilities committing capital for long periods of time, 5 to 10 years, and miners being able to sit on those contracts, go out, and actually develop assets, because you've got kind of this match between a long reactor cycle, takes 6 to 8 years to build a reactor, and takes 8 to 10 years to build a mine. So in order to incentivize that CapEx on the mining side, you needed these long contracts. So apologies if I'm going through some 101 here, but
this is awesome for keep going.
Yeah, if it's your first time, it's very important. The spot
exactly.
price
For those who don't know,
tends to drive headlines. It just doesn't really matter all that much. So, so you've got this contracting cycle, and what people forget is that right before Fukushima, you had 4 or 5 years of heavy contracting. You had uranium prices start to move, and everybody hit the market. And when that happened, you had
and they did that because their biggest fear is not having enough supply. So when prices go up, it's because there's a shortage. So they run out and try and make sure they secure it. So sorry.
Correct. So as prices rise, you generally see two things. You see an increase in contracting, and actually historically you see an increase in inventory, which is maybe a different topic we can touch on later. But you tend to see security supply concerns really drive a lot of the dynamics of this market, or at least you have in previous cycles. So why does that come back to where we are today? Well, the combination of having the pantry full into this disaster and this incremental supply coming online means that you had an extremely deep bear market. And only now are you starting to see those contracts roll off. So, I mean, the same way that people, I think, incorrectly can frame utilities as dim-witted, I think they're extremely smart. I think Camco has actually played the cycle pretty well. I mean, I think Tim and Grant are extremely smart people who understand exactly what the future looks like. They understand supply and demand dynamics. And if they had started to make real supply reductions a few years back, we wouldn't be forcing utilities into this current dilemma, which is, I know I've got a supply-demand issue that gets really extreme in the middle of the next decade, and I know I'm uncontracted. Push the issue because of this delay, if that makes sense.
Yeah, no, it does. So, so here you are, you're coming up as the utility market is coming up a period where those contracts are starting to roll off, and we've seen supply cut pretty dramatically. Now, you and I get asked this question a lot by people on Twitter or people who will email you, and they'll say, well, what are your supply and demand numbers? Now, what I always say is I think we are currently in a very big deficit, and we are going to get into a dramatic deficit over the next several years. Now, I don't share my numbers publicly because, and you and I have said this, and you just said this to me earlier today when we were speaking, you guys don't do it because you're not a charity, and I don't do it because I'm not a charity. We have investor obligations, and they're the beneficiary of that. But we see a major supply deficit that's forming, or has formed, and the supply has only now just started to come offline. Supply was increasing during the downturn. And people ask me, and I'm sure you guys get this question as well, how did that happen? And well, I think there were two things that stand out to me that were pretty obvious when I started looking at it. Was one, nobody ever anticipated the restart of the Japanese reactors, which were 13% of world demand that went offline after Fukushima. Nobody thought it would take this long to get them back up and running. And then secondly, I think the market looked at the end of the megatons to megawatts program, which is where in 1993 to 2013, the Russians were incentivized by the U.S. to downblend about 22,000 intercontinental ballistic nuclear weapons from high enriched uranium to low enriched uranium. The U.S. didn't want to see that when the wall fell and Russia was broke. They didn't want to see it wind up on the black market. So that was putting about 20 million pounds a year at times into the market. And I think the industry looked and said, okay, well, Japan's going to come back online. They need to, and this is ending, and so it's going to be all good. And in the interim, you had this massive, a big increase in supply that came online, and that takes a while to reverse. And so now we've seen these reductions, but in supply. For you, that I think there's a significant primary, obviously there's always a primary mine supply deficit. The secondary is what makes up the difference, but I see big deficits coming into the future and starting now. How are you guys thinking about that?
I think you're right. I think the one thing that people kind of forget in this market is that even at that peaky bull market that we had, in 2008 and 9, you didn't actually have a deficit. Our current deficit, which is largely due to a series of supply cuts. We've taken close to 50 million pounds out of the market in the last 18 months. It's the first deficit we've really had since the early 90s. And so I think that you have a market that, due to megatons to megawatts, due to the sticky nature of contracting and a lack of rationality on the supply side, hasn't really had to act like your average commodity for 30 years. And so I think that if we think back to what drove the last move, it was a perception of a supply shortage.
Yeah.
And if Camco and Kazatomprom and Paladin hadn't cut any pounds, we were still going to get to a deficit. It was just going to happen, 5 or 6 years out, depending on how you run the numbers. What these cuts have done is it's pushed that event to today. And I don't think utilities yet fully grasp what that means. I mean, let's just go back. When Camco made the initial MacArthur shutdown decision, I think they believed it would be enough to force utilities across that bid offer. Mm-hmm. I think they believed the headline alone would force conversations to occur, and they could sit down and rationally argue why we needed higher prices to support the industry and to make sure that nuclear reactors stayed online globally. What happened right after the initial shutdown, the 11-month shutdown decision, was 232. And it threw a monkey wrench into things because those utilities that would have come right to the table and started conversations pushed things out. Regulatory uncertainty is never a friend of markets. And nobody's going to commit to additional supply when you might have the U.S. government coming in and requiring you to purchase domestically. Yep. So I think the 11-month shutdown was maybe enough to get the conversation started. It's obviously been pushed out. And as a result, you've now fired those workers. It's now going to be a longer restart. And so I think the answer is we are in a deficit. And the question then, Mike, is if we're in a deficit, and you're so right, why haven't prices moved?
Yep.
I think that's more where you get into a regulatory discussion about 232 and what the resolution will do to this market.
And for listeners who aren't familiar, Section 232 was a petition filed to the Department of Commerce by Energy Fuels and UR Energy, two producing U.S. miners. On the grounds of national security, they want the government to require U.S. nuclear power plants to buy 25% of their uranium from them. The U.S. consumes 50 million pounds of uranium per year, and it produces under 2 million pounds. And so it imports almost all of its uranium needs for its nuclear power plant. Why does that matter? Well, nuclear power is 20% of the U.S. electric grid. So 1 out of every 5 homes or businesses are powered by nuclear power, which is just in and of itself, most people in the U.S. who are casual people living their lives probably wouldn't recognize that. They think nuclear power is a thing of the past, but it's meaningful. And the view by the miners is, hey, listen, of those imports, any given year, 35, 40, more than 40% can come in from Kazakhstan, Russia, and Uzbekistan. And, for those of you just casual observers of life would know that while we are not at war with any of those countries, there's certainly they don't have the U.S.'s best interest at heart, one could argue. And for more keen observers and those paying more attention to geopolitical winds that blow, you can make a very strong argument that we're in Cold War 2.0 with the huge anti-Russian sentiment. And the Russians and the Chinese use energy as a geopolitical weapon, and it's a powerful tool for them. And Kazakhstan, while not a Soviet nation, a Soviet bloc country anymore, it could be very strongly argued that will march to the beat of Russia. And should Russia, which controls half of the world's nuclear power enrichment, uranium enrichment, and by extension could be argued controls Kazakhstan and other countries, Uzbekistan, through their own political will, that can have a serious national security risk to the U.S. Because don't forget, it's not just nuclear power that light our homes and businesses. The Navy relies on it for its aircraft carriers and nuclear submarines. And so that's the complaint that Art's talking about, Section 232. And that was filed in January, right after MacArthur River was, Cameco announced the temporary closure. And that threw a wrench. And the Commerce Department picked up the investigation. They agreed to do it in July. And they have to rule on it, whether or not they recommend to President Trump by April of 2019. So that's caused a delay in the contracting cycle that the utilities are aware. And Arthur, like you, we go to all these conferences and we sit and meals together and we hear the tone, and the tone is markedly different than it was 18 months ago. But one of the things I want to drill down on is a couple of things. Is the cost curve. One of the things that, and when I spoke at the NEI in Boston, I said to the fuel buyers, by the way, great job, kudos for not buying all this time. You've got much better prices. But when you look at the presentations many of these companies present, they're not a full representation of what the actual cost structure is. That during a very long bear market, it's in the best interest of these companies to present their cost structure when they're out looking to raise capital in the best light. And I say it's not a violation of any. It's just where they put it in their P&L. And so they may be presenting a certain type of cost and saying it's their cost may not include depreciation and amortization, may not include sustaining capital costs. It may not include marketing costs. It may not include transportation costs. And that when you actually analyze these costs, their costs are meaningfully higher. So can you talk about your view of what the cost curve looks like?
Definitely. I think that this is one of, if not the most misunderstood dynamics in the uranium market. I believe that companies have portrayed their costs in a certain light for the right reasons. I mean, they don't want to close shop. They need capital to survive. They're trying to make their way through a bear market. So they're trying to retain their employees. But at the end of the day, showing
and it shows up,
cash
by the way, it shows
yeah.
up in their net income. It's not like they're hiding it; they're just putting it in different buckets. Right. Exactly.
Well, exactly. And so, but I think especially for an investor, if this podcast is more focused on investors maybe approaching the market for the first time, if you pull up just a group of company presentations, you'll see costs anywhere from the mid-20s to the mid-30s, give or take, some a little bit lower. And then you'll sit there and say, well, isn't all this supply coming on at 40? And the answer is it's not, because the majority of the time, the costs that they're showing are significantly skewed. They can be skewed because they're showing a C1 instead of an all-in. They can be skewed because they're showing it from specific years when they may have been high grading.
C1 is just the cash cost to produce is
correct.
It's not the costs like the DNA and the sustaining costs. So yeah, go ahead, Art. I'm sorry.
Yeah, and listen, if you've got a currently producing mine and you're going through a short bear market, C1 might be interesting to look at because you might keep that mine open as long as you're still, covering your cash costs. But what we're talking about here is an industry that's been through an extremely deep bear market. The decision process for most of these assets is not a question of keeping the doors open. They're usually already on care and maintenance or they're still in development stages. So what these companies need to do to justify bringing on additional production is to actually go out and, in many cases, spend significant capex on getting an asset up and running. They have to go out and hire teams of people to operate that asset. And I think the biggest disconnect is if you talk to management teams, the same guys with a mid-$20 cost estimate in their presentation, when you ask them what type of contracts they need to justify bringing on assets, often they'll be at a $60 range. And so that disconnect is where I think a lot of investors get lost because they don't really understand the all-in cost for these entities. As an industry, they'd be better off if all of these corporations got together and said, we're going to create an AISC like the gold industry has. In that case, utility buyers would see the all-in costs of the industry, and they would sit there and say, we're going to need higher prices to justify pounds, and we're going to understand when a company comes to us and says they need a $60 price, because that's really what they need to produce. What we have now is every company out, kind of competing with each other for capital and arguing that they're the lowest quartile of the cost curve. When in reality, they aren't. And as a result, you have skepticism on the buyer side because they think there's all these assets out there just waiting to come online at lower prices when there aren't. And it also, I think, kind of damages investor psyche because you meet with these management teams and they'll spend half the time talking about how great their project is and half the time talking about how terrible the next guy's is. And so I think...
Go ahead, Art. Yeah, because I'm going to touch on that when you finish. Yep.
Yeah, it's a lot of mudslinging and a lot of skepticism. And at the end of the day, you also need to sit down and spend your time trying to compare assets on an apples-to-apples basis. So, it's a whole other conversation to talk about whether EV to pounds is a good way to think about valuation. For a million reasons, I don't think it is, but I think a lot of, early investors will focus on dynamics like that to figure out whether a company is cheap or expensive. I'd say they have to spend a lot more time looking into the details of the asset, compare a long life, high grade asset in the basin in Canada to a, ISR project in the U.S., if only because they have very different lives. You're talking about a lot of assets in the U.S. that can produce 500,000 to 1 million pounds, but they're only running for 4 to 6 years. So at the end of the day, trying to think about what a levelized cost of production is for a company. And once it runs through the pounds that it currently has defined, how it's going to prove up its secondary resources and bring them into production, how much capital that requires. Yeah. I'm just trying to say there's a lot of work that goes into understanding what the real cost of these companies are. Well, and a cursory view is I think, really going to hurt people as the cycle does turn.
Yeah. Well, it's so fascinating. When you go to at the Nuclear Energy Institute conference, there's a sign at the door at the check-in. Don't talk pricing. You can't. Essentially, with all the industry participants, they're worried about collusion. That it's you can't be seen as colluding on price. And I find it so fascinating because you just said what jumped out at me. I've been meeting with CEOs and CFOs of companies for 20 years. I mean, like you and Adam, you could do these meetings in your sleep. You could look at a P&L, a balance sheet, or a cash flow statement after being a generalist investor, professional investor for all these years, and without even really knowing what industry the company is, look at the numbers and kind of get a sense for what type of industry they're in. And meeting with these guys, it's just kind of what we do for a living. And so you've had exposure, I've had exposure to countless executive teams from industries far and wide. And when I first started meeting with the uranium CEOs, what's jumped out at me was all you guys do is mudsling. All you do is slam everyone else's project and say how you're the lowest cost. And one of the things I like to do as an investor, Art, is lift myself out of the room and look at it through my mind's eye. Like I'm up in the corner looking down on the conversation. And what would a casual observer think? And as I started to do that, met more and more of these management teams, I thought, you guys are silly. You're all in a bear market, and you're all fighting to stay alive for that investor capital. And you're all fighting about why this guy's project isn't as good as your project. But at the end of the day, it's the cycle you should be focused on. And what I found was most of them were following the same data that's out there that you and I, when we've done the work, think is not accurate. And rather than focus on what's going to drive the macro market, they were focused on, because that's what matters, no macro market in their favor, it doesn't work, but the macro market could help drive their capital decisions, their capital raising decisions, and what to do things. But it struck me that these guys are just sitting there and fighting, and the cost side. So I went back to people worry about collusion on the price side. You don't have to fight. All you need to do is show the industry just what you said. And I would say this to management teams: tell people what your real costs are. Who are you pandering? At the end of the day, you need the utilities to understand your cost structure. If everyone just said what your true cost structure is, that's actual, honest cost structure. That is going to get the customer of your product to recognize you need much higher prices. And that's not the tack this industry has taken. And it has never made sense to me. And it just goes on to more and more management teams I've met in this industry, and not to name names, which I won't, and I know you won't, but it's so important to be with a good management team, because the rest of the time they're just diluting the living daylights out of shareholders and telling you what their costs are going to be. And you and I know when you go through these cost structures, they're a lot higher.
Well, but what's so funny is, I guess I'd say two things. One, the reason there's all that, I think you know this, Mike, but the reason there's all that fear about looking like you're colluding on price is because there was this large uranium cartel in the late 60s and 70s. And if somebody wants to, really dork out over the Christmas break and read a book, there's a book called The Great Uranium Cartel by Earl Gray. And it's only in hard copy too. Yeah, you got to order on Amazon, but it's worth reading, and it shows how in 1976, this was on the front page of every newspaper in the world. that this huge uranium cartel had been cornering the market for years. And so as a result of that, the industry has a long memory, and people are very nervous about trying to talk about where costs should be and where prices should be set, because they're going to be viewed as doing the same thing. So that's one point. And the only other thing I'd say is, when you sit down with these CEOs, and that's what I think, for your average investor sitting at home, just reading about these companies, it can be a little bit difficult, because when you push the CEOs on where they really need prices to be, they'll tell you. They're not. It's not as if they're not thinking about it. Let's just take 232, because we were talking about it a moment ago. Let's say 232 passes in favor of the U.S. producers tomorrow. Okay, you're going out and hiring hundreds of people into an industry that hasn't been hiring for 5 or 6 years. You are scaling up 10 to 12 projects in 5 or 6 states. You are full steam ahead. You probably need 60-ish drill rigs, because again, these are in situ projects. Where are you getting those drill rigs? You're competing with the oil patch for a lot of that talent and for a lot of that hardware. If you think that going back to some 2014 cost estimate when you were high grading because you were in a bear market is going to be a good representation.
For those who don't know, and it's a very important point, listeners, high grading has helped some of these companies survive the downturn, but explain what that is.
Yeah, so it's to put it very simply, you're choosing where you are mining, from an ISR standpoint, to maximize current production and keep your costs low per pound. The result can be stranded pounds, and unless you have a plan to circle back and look at those fields a second time, you're actually not optimizing the asset. And the reason I highlighted it, because a lot of presentations will show, producing assets in 2014 when a lot of producers, I believe, were high grading assets to try to survive through a 3-year down market. Those assets oftentimes are subsequently shut. And as a result, you have a skewed understanding of where costs are going to be when we re-ramp. If you add in all the cost inflation from rushing to hire all the same individuals, getting those drill rigs, and trying to ramp up production as fast as possible to meet a Department of Commerce quota, you're going to not produce those pounds anywhere near, I think, where your average investor would think you do based on your presentation. So I think 232 is going to result in a ton of cost inflation. I think those pounds are probably priced more in the 60s or 70s. And I think that people need to be cognizant of that. And when you meet with the management team, when you talk to these companies, ask, Commerce comes out tomorrow in your favor, who are you hiring? Where are you getting your drill rigs? Where's your capital spending going? How much do you have to raise? How are you going to do it? Do you have bank access? These are all questions that are extremely important. And management teams that have thought about these dynamics and have a plan will create value for shareholders. Those that are going to worry about that when the ruling comes out, I would just be skeptical of. And again, I don't want to go down the road of single names, but just to say that it's much more complex than, does 232 go one way or the other?
And the other point on cost chart, and when I spoke to the NEI group, I brought this up. I said, look, here's primary supply, here's secondary supply, and here's demand. You see that white space? That's all on the chart. That's all new supply that needs to come online. And I put a list up. I put a slide that showed over 30 projects. And I said, a lot of these projects are going to be needed to fill this massive supply deficit that's forming. And I put next to each one the price that's required from a pre-feasibility study standpoint, and the PEA, and it goes PEA then PFS. I said, here's the required price, with the exception of the one in Spain and a couple of tiny ones that don't matter. It's a minimum of $50, and many of these projects need $60, $65 uranium. And I said it's because that's the required internal rate of return that's to generate the financing, to get people to be willing to finance these projects. It's based on this commodity price, on this uranium price. It's not a number pulled out of thin air. I said, but also many of these feasibility studies were done years ago. And there's mining inflation, and so these prices are too low. So even though in a feasibility study I said they put their best foot forward, and you have to look at what the IRR it's based on and what the NPV and all the finance project stuff, but that too is going higher. So yes, the U.S. has that specific inflation, but a lot of these studies are old, and I think in such a long bear market, people forget that mining inflation exists. Art, so look, I know you got to catch a train, and we're running out of time here. I'm going to have you back too, but we're kind of time squeezed today. Any parting thoughts on uranium that you want to share with listeners?
Yeah, I mean, I guess I'd say that, I think the macro in this trade is pretty fantastic. Clearly, we're spending a tremendous amount of time on it. We're dedicating a ton of time and resources to the space, and I think that's valid. I would just say that in this trade specifically, I think the micro is just as important. I think that there are some great companies out there. I think there's a lot of snake oil. I think that investors should approach the space with a ton of skepticism. And I would just argue that making sure that you understand what you are buying, the regulatory risks, the project risks, whether the management team is the right team in place to take you to a path in production, is where you need to spend your time. And I think that from what I see, whether it's on Twitter or other posts, there's plenty of commentary that says, well, it's only $10 million, so it's got to run. And everybody looks back at the chart of Paladin from the last cycle and thinks they have the next one. And I would just say there's a lot of positives in this trade, but things are so mispriced that you don't need to take flyers. You don't need to approach this as a basket of options. You don't need to buy the worst and assume they're going to run the most. There are quality businesses, quality companies, quality management teams, which are drastically mispriced. It just takes a lot of work to understand who they are. So that's I guess, where I'll leave it.
Great. All right. Well, I'm going to have you back soon. And
the only other thing I'd say is if people are interested in continuing the conversation, I guess you can just.
Sorry, Art. I meant yep.
Why don't you email me? It's Arthur, ARTHUR, at Segra, SEGRA, capital.com. Thanks so much.
All right, Art. Talk to you later. Well, I hope you enjoyed the conversation with Art. Art and Adam, just super smart guys. We've gotten to know each other a lot over the years, and I really enjoy talking with them. And, you kick out, and believe me, and we're somewhat time constrained today, and I'll have them back on soon, and we'll talk about other stuff. But it's always, it's always good to get some insights. And, look, I'm aware. Obviously, we're both bullish on uranium, and there's always a positive feedback loop, right? And we'll get back and we'll hash out the bearish stuff. And I talk about uranium a lot. I get asked plenty of the bearish stuff, and people know where to find me. But hope you enjoyed the conversation with Art. Hope you have a good week, and I'll talk to you next week.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.